Hey, Facebook. It's Brad and my friend and lender extraordinaire, Ed Diaz here.
Good morning, everybody. Happy Monday.
Super excited today. We're launching our inaugural video interview series using Facebook Live. And the goals are kind of multi-part here. Number one, Ed and I get a ton of questions every day, and they're fine from people, buyers or sellers, looking for information. So first goal is audience education. Number two is transparency. I think there's a lot of moving pieces that go into the real estate process, and it's confusing for everyone involved, buyers and sellers and everyone else. So just to try to be more transparent about how we think about things and kind of elevate the conversation around what's most important. And number three, because Ed and I are having these conversations every day, we kind of thought, what's the best way to reach an audience at scale? And Facebook Live is one of those opportunities for us, so we decided to test it out and see how it goes. So
be nice to us.
That's that. Obviously, we want to make this as interactive and as informative for you guys as possible. So if you guys have questions throughout, feel free to drop it into the comments. We will get to those as they come about. As I mentioned, I'm here today with my good friend Ed Diaz from Movement Mortgage. Quick introduction on Ed. He has over 20 years of lending experience. Before that, also was in the financial advisory and wealth management worlds. So I love sending clients Ed's way because he has a very holistic viewpoint on every individual situation, and so can really make strategic recommendations about how to approach the buying or selling process. So that's my take on Ed. Ed, you want to talk a bit about yourself?
Yeah, absolutely. And thank you for inviting me on this inaugural cast here. We're letting the ship out. Yeah, as Bradley was saying, we're in this 24/7 every single day, and we read much of the same stuff that you're reading, and we look at this, and sometimes we look at it and we're in shock at the misinformation that's out there. And as you know, there's so much information that you can read. One article that says, right now is a great time to buy, and then 2 minutes later you can read another book or another article that says, don't buy, it's the worst time ever. So I think with us being with boots on the ground, so to speak, it's a great forum to be able to educate, and again, as Bradley said, to be really transparent and just give you guys information as to really what's going on, particularly here in San Francisco. I've been here since 1968. Ugh.
It's been that long already?
Yeah, it's been that long, and believe me, it goes that quick. For those of you who are in your 20s, it'll go fast. And back then, you could buy a house. Can you imagine $15,000 to $20,000? And now here we are, going into the $1,000 to $1,500 price per square foot range. So I think now more than ever, it's important that you build a team and you have people that are very transparent and very knowledgeable that do this day in, day out. It's not just a hobby, so that we can provide you information. And more importantly, I think it's to provide you guidance as to what your options are and what your capacity is. Because the last thing you want to do too, and we saw this in 2006, is getting in over your head and being house poor. And that can happen very quickly, especially in high-priced areas such as San Francisco.
Good. Thank you, Ed. So we're going to keep this focused on both buyers and sellers today. I think it's great to have Ed in the room because he, again, has a wealth of knowledge from multiple perspectives on this. And we're going to make this an interview, conversational style. I'm not going to grill you, I promise.
Oh, okay.
Not yet, at least.
All right,
unless
good.
the audience asks me to.
I'll let my mom know.
Yeah, you're safe here for now. This is a safe environment. So I guess one of the first questions I want to start with, Ed, is, and this is a common thing I see with buyers today as well, and this is no one's fault, with the emergence of the Zillows and the Redfins and the Trulies of the world. A lot of the discovery of properties happens independently. People go on their apps, on their desktop or computers, and just start searching for stuff on their own. And I feel like a common misstep, I don't want to call it a mistake, but a misstep people make is they find these homes, they fall in love with certain neighborhoods, certain price points, and then they call an agent or a lender and say, hey, Ed, I want to buy this house. What's it going to take? And my recommendation always is, even if you're super early stage in the process, talk to someone early on who can at least give you the high-level guidance. Even if you're a year or two away, you still want to make informed decisions. You still want to be able to get coaching on how to repair things on your credit, for instance, if there's issues there. So what's your recommendation on how to best engage someone like yourself and when to do it?
Yes. I've always lived with the mantra, know before you go. And I think that that's true with any big financial decision. It's super important that you know your numbers, you know your capacity. That's one of the big C's. So it's important to go in as early as possible. The moment you start thinking that you want to buy a house and you want to make that big commitment, because it is a big commitment, I think that's exactly the time. It's not about going to look at houses and falling in love first. I think it's the opposite. You want to fall in love with a house that you can actually get the keys to. You don't want to go in too early. As far as looking at properties, you want to get in very early as to knowing what your numbers are, because lenders are going to look at, and they're going to go into the minutia, especially now after the whole meltdown. They're going to look at your 4 areas of your finances: assets, credit, income, and debts.
And we'll get into that in some subsequent questions here, so stay tuned on that. And again, for the audience, if you guys have any questions or comments, feel free to drop them in there, and Ed and I will pick those up as they come. Kind of going one level deeper on that, Ed. So another common thing I hear, it's a misconception, is kind of the glossary of terms that exists in the real estate world and lending world. I mean, there's literally thousands of terms out there, maybe millions, who knows. And a common one regarding lending is the difference between someone that's pre-qualified versus pre-approved. And then there's one level deeper, you're having a fully underwritten loan. So from your perspective, what's your take, and kind of tell the audience how those things differ from a lending point of view?
Yes, excellent question. So here's what happens. There are 2 different worlds. There is the pre-qualification world, and then there is the full approval world. The pre-qualification, just to keep things simple, is really a loan officer such as myself, their best guess approval up front. They've looked at those 4 areas of your finances that I mentioned: the credit, the assets, the credit, the income, and the debts. And then, based on what they see, they issue a pre-qualification letter. So notice how I have not used the term underwriters yet. A full approval is when the actual underwriter, who is the final decision maker, by the way.
Who's not you, correct?
Who is not me.
Someone else.
It's not a loan officer. It's not the branch manager. They're actually called underwriters. They will look and scrub all of your information, and based on today's rules and based on guidelines, they're going to make a decision as to whether to approve or not approve your loan. And why that's important is because when the underwriter approves it, that's essentially good as gold. You have now what's called a loan commitment as opposed to a pre-qualification.
So just to be clear on that, that first one regarding pre-qualifications, that can be as simple as a conversation with you face-to-face or over the phone. No docs from the buyer side have been submitted, no income, no assets, nothing. It's a conversation, it's all stated by them to you.
Right, that's what I call the napkin presentation, right? We're basically just doing numbers and pulling out calculators based on what you tell me. So let me give you an example of how that could change once an underwriter sees it. So let's say I ask you, what's your income? And you say, oh, well, it's $5,000 a month, or I get paid, I get paid every 2 weeks, $2,000. And so they think that they get paid $4,000 a month. Well, most people would think that, but think about it. There's 26 biweekly payments in a year, so it's actually 2,000 biweekly payments times 26 divided by 12, not times 2. So it's not 2,000 times 2. That's another example of where things start to go awry. And then reserves and other requirements besides just down payment, of which we know the mortgage industry now is back to the 90s. We're looking at all of your information.
Gotcha. Thank you for that. And I think it was super helpful when you came in a few months ago now. You gave a presentation to KW, Keller Williams, kind of about these similar topics. And one of the things that I really took away that I'm sharing with the audience today and with buyers I work with is the components that go into the financial review that you do. So you mentioned the 4 areas. I'd love to hear from your perspective kind of what those are and how you think about them.
Yeah, absolutely. So we're talking about assets, credit, income, and debts. I like to call it the acid test just so that the memory retains it. So on the asset side, we're going to look at what is your capacity for down payment and also closing costs. Keep in mind, closing costs typically are between 1.5% to 2%. But guess what? We're not only looking at how much money you have for down payment, but we're also looking at where is the money coming from. I'll give you an example. In a lot of cultures, in my Latin culture, it's not atypical to have cash literally lying around in the house. And so when they
Don't tell them where you live, by the way.
Yeah, no, I'm not giving out address. So when they're thinking about buying a house, guess what they do? A day before they go and talk with me or they talk with Bradley, they put $20,000, $30,000 in cash and they deposit it into the bank. Well, that's not going to work. The banks will not recognize and will not accept cash deposits. Why? Because there's a lot of money laundering, there's a lot of fraud going on, etc. So that money needs to be seasoned for 2 months. Another thing that people don't realize is that you can. The answer is yes, you can get gift money from relatives in order to buy a property. So that's on the asset side. They're going to look at that. They're also going to look at big deposits. Let's say you're depositing typically $5,000 a month because of your income, and all of a sudden there's this big $20,000 deposit. Well, they're going to want to know, where's this money coming from, and you have to source it, we call it. On the credit side, there's 3 credit reporting agencies. There's Equifax, Experian, and TransUnion. So in the mortgage industry, we use what's called the middle or the median score. Little did you know you were going to use that little math thing again, right? Remember, we thought we weren't going to use that.
Not the average, not the average.
No, it's the actual median. If you remember in math, that was one of those math things that I never thought I'd have to use again, but here I am using it every day. So we use the middle score. So we eliminate the high, and we eliminate the low, and we use the middle score. So guess what? What happens if you have more than one borrower? So now what number is going to be used? We use whoever has the lowest of the median scores. Then we get into income. Essentially, just to keep things simple, there's 2 types of income. There's either you're working for someone, right, and you get pay stubs and W-2s at the end of the year, or you're self-employed, and you're either a sole proprietorship, or you have a corporation, or you have a partnership. Those 2 things are treated completely different. When it comes to self-employment, which, by the way, here's another thing that people don't know. You're considered to be self-employed when you own 25% or more of any entity, believe it or not. So you don't have to own 100% of it to be considered self-employed. When you're self-employed, we're going to do cash flow analysis as opposed to just looking at your pay stubs and your W-2s, as an example. And then finally, we're going to look at your debt. When we pull a credit report, we look at 2 things. We look at your credit scores, and then we look at your debts. Now, did you know that when we look at debts, we're looking at the minimum monthly payment that shows up on your credit report? So let me give you an example. Let's say you owe $10,000 in credit cards. You're paying $1,000 a month because you want to get rid of the debt, but the minimum payment showing up on the credit report is $200. Guess what we're going to use? It's going to be the $200, the minimum monthly payment required. So then when we look at debts and we look at income, we're going to come up with what's called the DTI. Here comes another term that we love to use in the business, and that means debt to income ratio. And different programs are going to have different maximum debt to income ratios that are allowed. So there you are. That's the acid test.
And we did get one question coming in. Let me just see this real quick.
All right. What do we got?
Ed, so the question for you is there a cap of gift money that I can receive or that someone can receive?
The answer is yes and no, depending on the program, but for the most part, no. 100% of your down payment can come from gift monies. But once you get into what's called the jumbo lending arena, which means that your loan amount is greater than $625,500, they're going to want to see you kick in at least 5% of your own money, and then the rest can be gift.
Gotcha. And actually, that's a great question. Thank you.
That's a great question.
Thank you for that, Steph. Because it leads right into the next question I had. It's a common misconception, again, about the financing side, and it's regarding down payments, right? The common rule of thumb that people usually think about is, hey, before I even buy a place, I need 20% down, 1/5 to get into this house. In conversations with yourself, you also share with me other opportunities out there for buyers, and kind of explain what those are and how you think about those as well.
Yeah, so this is a very robust realm here, because the truth of the matter is that you could get into a house with no money down. And what do I mean by that is there are programs that allow, for example, FHA, which is Federal Housing Administration, allows you to put 3.5% down. But here's the other side to this coin. You can go to, depending on what city you're looking to buy, and you can see if that city or county has any down payment assistance money that you can partner up with it. And there's programs out there that will give you anywhere from 3% to 5% of down payment assistance, which in essence, as I just described, if the program requires 3.5% and you're getting 3 or you're getting 5%, then you would use that money for both down payment and also closing costs, which in essence you get in with no money down. But the reality is that no, you don't have to have 20% down. Even in the jumbo market, which again, that means your loan amount is greater than $625,500, there are programs that allow you to do no money down, and even you can get a no money or a low down payment down program with even the mortgage insurance already put into your interest rate, which is another option and another video. But there are a ton of options, which, by the way, can you see why it's important to start going early, to start planning for the home purchase?
That I was going to say, just to cap that question, that was kind of my point there as well, is there's so many opportunities and programs out there for buyers and sellers that no one knows about, that it's in your best interest to talk to someone sooner rather than later, before you go down a path of self-education and you're end up in the wrong area. Talk to someone like Ed or myself and let us kind of redirect you, course correct, to get you on the right path there.
And I wanted to say something because you mentioned it this way and it kind of just triggered. I can't stress enough the importance and power of having a team. So, for example, if we're going to meet, it's important that we all meet, because it's something very interesting happens when you meet with the team. The power of brainstorming and creativity really just takes off. So when we meet with you together, not only are we covering the financing side, but we're also covering the possibilities on the real estate side. And so when we put both of those things together, it's super, super powerful. There's no need to be meeting with one person one time and then another person the other. I think the power of meeting in one place and brainstorming and really talking out all the options is really, really powerful.
And also on that point, I mentioned it earlier at the beginning of the conversation, buyers don't really realize this either, but in the buying process, there are probably 20 plus players involved from end to end. So it's not just Ed and myself, the agent and the lender. There's the appraiser, the contractor, the listing agent, the buyer, the seller, all these players involved, the escrow, title insurance, that are all pushing in the same direction to make this thing, you're purchasing your home, happen. So the earlier that everyone can be aligned, the better.
I'd like to say something about that. As a matter of fact, on the lending side, just on our side, the average is about 20 people. So that's not including what he just mentioned, the appraiser and the title company. So having all those folks moving in the same direction, much like a train, because we're only going to be as efficient and as quick as the slowest and least efficient person, if you think about it.
Yeah, and let's switch gears for a second. We're still talking about lending topics, but let's talk about rates. I know you love that. I love you. I tell people in my monthly newsletter, and if you're not signed up for that, please ping me and I'll put you on there. But in the monthly newsletter, I've been talking for the last few months now about the historically low interest rates and what the implications are for buyers and sellers. But you're using the business, where rates are and kind of how you see them today.
Well, let me jump off by
Sure.
just saying this, that the average rates in the last 5 to 10 years have been really 5 to 6%. And right now we're in the 3%, right? So 3.5 is about where everything's hovering, 3.375 around there. But here's what's really important for you to take away from this conversation. The knowledge of how rates actually work. Most folks think, well, let me...
We're back.
I think we're back. Yeah, we had a little glitch. I think that might have been Mercury trying to be in retrograde. But so what I was saying is, what's really important you take away from this is how rates actually work. Most consumers, what they'll do is they'll go online or they'll call a bunch of different banks and they'll find out who tells them the lowest rates. Well, one thing I want to just mention really quick is that the loan officer nor the bank determine the rates. Rates are determined by the buying and selling of 10-year treasury notes, or bonds as we call them, in the secondary market, much like stocks are. So what's important for you to know is this. Here's the general rule. When there's bad economic news, that's good news for interest rates because rates go down. When there's good economic news, that's bad news for interest rates because interest rates go up. Now, why is that? Well, if you think about it, there's two buckets, right? We have the risky bucket and the safe bucket. Let's call the risky bucket stocks. Let's call the safe bucket bonds. Remember when Grandma used to keep all those bonds? I don't know if your grandma did, but my grandma definitely did.
Yep.
Those bonds were super safe, and that's why she bought them. Well, when there's bad economic news, think about what your emotion and what your brain says. It wants to fly to safety, right? So what ends up happening is that money moves from the stock market and it goes into the safe bucket, right? So it goes from the risky bucket to the safe bucket, and that's called bonds. And that's why rates go down. Now, when the economy's doing really well, we get kind of frisky, right? We want to go shopping. We feel good. So what ends up happening is that the brain says, okay, now we can take money from our safe place and we can put it into our risky bucket. And so rates go up because they're moving money into stocks.
And just to be clear on that, I think Ed made a really good point there. Ed is not the one dictating the rates to borrowers out there. He's not looking at your financials and saying, okay, based on this, here's the rate I'm going to give you. That's not correct.
That is, you're absolutely 100% correct. So here's what happens is that's why they call them teaser rates, because the truth is that rates go up and down, right, depending on what's going on. Much like stocks. Why do stocks change? Like Apple doesn't change every minute, but their stock is always changing, right? Because there's economic information coming from all over the world in real time. There's a lot of trading going on. So what's important in how we say this is that, and here's where me being a advisor in the past really comes into play, is what I'm going to do is, first step is to get you approved, know what your capacity is. And then once we're in contract, then I'm going to research and watch the markets so that I can advise you. Because remember, I'm the professional, right? I've been doing this a long time. I'm going to advise you as to when to lock in the rate. Why? Because we want to catch those dips. But we can't catch those dips if all I'm doing is reading off a sheet going, yeah, my rate is this today. But that doesn't matter, because by the time it goes to print, the rate could have already changed. So we want to be a little bit more proactive instead of getting caught up in these teaser rate wars.
And actually, that leads itself great to the next question about refinancing. And the reason I thought about this was when rates continued to drop, you were on the phone calling your clients, telling them, hey, now is the time to refi.
Yeah.
Right? And so the question is, for people who own out there and who already have locked in rates, just big picture refinancing, kind of what it is people don't know, and when they should think about doing that.
Yeah, there's a lot of thoughts, a lot of schools of thoughts as to, refinancing and pulling equity out of your house. There is a book called Missed Fortune, which, expounds the benefits of using your equity. Because if you think about it, in reality, your equity is essentially cash that is sitting in your freezer at home, right? You're really not doing anything with it. And I'm not
in the mattress.
Or in the mattress, right?
Yeah.
I'm not saying pull a bunch of it out or anything, but here's the thing. If you are paying, think about this for a second. If you're paying, let's just say, 3.75% on mortgage money, and you took some of that equity out and you invested it, and you're averaging 7 to 12% on that money, doesn't it kind of make sense long term? Because here's the thing, especially in the Bay Area, we decrease on an increasing basis. What do I mean by that? Even when things go down, over long term, you look at every chart, prices always go up because of all the things that makes the Bay Area so great. Jobs, the geography, right? The climate, everything is here. And we're at the epicenter, especially right now, of technology. Not to say that sector is going to make the whole world, but we can't eliminate it or look the other way. The truth is it's a powerhouse, and there are a lot of great companies that are going to be around for a long time. Sure, there's going to be companies that won't, but prices are going to continue to go up. I attended a symposium of builders that say that for every unit that they build, there's 8 people that want that unit. Think about it. Next time you're on the road, look at all the license plates from different states. That'll tell you everything. People come here from all over the country and really all over the world. San Francisco is a mecca. So I think sitting down, and again, here comes the power of expanding your team. You should have a financial advisor. Maybe looking at that and running it by your tax person as well to see, is your equity really just dying in your house, or can you put it to work and make it wear a suit and tie like me and make it go out there and really work for you? And something that won't bet the whole farm, but that'll get you a greater rate of return than what you're paying in the interest rate on your mortgage, which, by the way, don't forget, your mortgage interest is also deductible.
Another topic that people don't know about and that I talk about oftentimes too is kind of the deductions around the real estate world. Okay, again, we'll switch gears. We had a couple questions left for you, Ed, so I definitely appreciate your time and all the advice so far.
Thanks again.
Another common question I get is kind of the timeline and the process. So, if I'm out there today just hearing this for the first time, I'm on Trulia or Redfin looking at stuff, looking at different neighborhoods. From the time I'm interested in a place, I sit down and talk to you, get everything, the docs you get pre-approved, to actually in the home with keys. Kind of what have you seen just to manage expectations around initial thought to living in a new house?
Yeah, so again, I want to stress the importance of first going to know what your capacity is, what you're pre-approved for, and what you can get actually approved for. In our case, one of the things that makes us very different is that we do everything up front. So when I sit down with you and we sit down and I collect your documents, from the moment I submit your documents, they go directly to the underwriter. Within 6 hours, you're going to get a full approval. And what that means is that you are now able to shop much like a person with cash, because you already have what's called a loan commitment, not a pre-qualification, but a loan commitment that allows you to put an offer with no loan contingency. And all that means is the loan contingency is the period of time that's given to you by the seller in order to perform on the loan to actually get approved. But with us, you're already coming already approved. The only difference is when you're doing a condo, that's a little bit different because we still have to vet the homeowner association, and sometimes maybe there's some things there. Maybe they don't have enough reserves,
enough financials,
or enough insurance, that sort of thing. But let's just say, right, within 6 hours, you're going to get a full approval. You now go shopping and fall in love with that house. You go with Bradley. The moment he puts in the offer, from there forward, within 14 days, we're going to close on your loan, which means they'll probably record. That means the title company will record it with the county the next day. So let's just say by day 15, you will have shiny keys and you're ready to go. And then we can move on to doing the housewarming party, which we do for every client.
That's another thing too. I've actually used that loan commitment letter, so thank you for that. Working with our buyers on that, Ed. That's another misconception. People think it's a 30-day close or 45-day close if you're getting a loan, and that's just not true. There are opportunities to compete with cash buyers by having something like the loan commitment letter. Again, that requires all of us working on the same page to get Ed all the docs that he needs to get that stamp of approval. But when we are making an offers with the loan commitment letter, I position it to the listing agent as this is just as good as cash. We're going to close just as quickly. Our buyer is just as qualified. Let's get this done.
And I'll tell you something funny has happened to me. And this is amazing, because the truth is that the industry has really brainwashed everybody into thinking that it has to happen within 30 days, and that's just simply not the case. Just like the 20% down thing, right? I've actually beat out 2 people that had offered all cash, which is unheard of for the most part. But see, here's the thing. Think about it. If you have a full commitment to lend from a bank, isn't it as good as cash?
Yeah.
Now, the whole thing, I will tell you this is where we take an extra step, where we literally have to contact the seller's agent to put them at rest, because it kind of sounds too good to be true. But in this case, it is not. We've been doing this for many, many years, where we have to talk with the selling agent, let them know and explain to them that this is not a pre-qualification letter, that this is a full approval, that we're ready to go.
Money is good. It's ready to go right away. Yeah, good. Also, I just wrote this down because you were talking about this earlier, but another area of potential interest for the buy-side audience out there is, okay, great, I got a lot of information today from you guys. I want to talk to someone about getting a loan. There's options out there, right? I can walk into my local branch, Citibank, B of A, what have you. I can talk to someone like Ed. Kind of what's the difference in your mind, Ed, between the big banks, the mortgage brokers, and the mortgage bankers? Again, more glossary of terms for you guys, but just again with the thought of being transparent and educating everyone, there are options out there.
Yeah, that's a great question. So a broker is really a middle person, right? So what they do is that they go to all the banks and they shop around your loan, and they're sort of in the middle, and then they get paid by those entities. The broker, the only issue, and I used to be one, and the only issue that I have with it now, and the reason why you don't see a lot of brokers out there, is because once the meltdown happened and the recession happened, they pretty much went away and they went bankrupt, a lot of them. The problem is, as a broker, you don't control the speed of the transaction. So many brokers are out a long way to be able to close your loan, which in this market is very difficult. If somebody's putting 10 to 15 offers, or getting 10, 15 offers on a property, well, you want to go in as competitive as possible. And let me tell you, one of the biggest competitive advantages is speed. So that's on the broker side. And then we have what are called mortgage banks. So mortgage banks are banks, and they have investors, and they have their own funds, but they don't do auto loans. They don't do credit cards. They don't open up checking and savings accounts. They strictly focus on mortgage lending, which is our bank. We have the ability to also broker, so we're best of both worlds, but we're also a bank, and most of our loans we do bank ourselves. And then there are what are called the retail banks, which are the Chases, the B of A's, and they do everything, right? They're pretty much jacks of all trade. Problem with a lot of the big banks is that they're not really specialists on the mortgage side. They do everything. It's much like, jack of all trades, master of none kind of thing. I'm not saying that they're not good banks. It's just a different approach, and they are going to be out there 30 days for the most part on closing your transaction, whereas we're coming in at 14.
Gotcha. We're right up against it in terms of time, so a couple last things for Ed. I wanted to leave Ed some time just to, I've asked some questions here, but kind of open topic for you. If anything else we didn't cover today that you think is worth sharing with the audience regarding the lending world, where we are today, economy-wise, anything you got?
Well, let me just make some bold predictions here. We're coming into the craziest election ever in the history of this country, right? Go out and vote either way. I think that's important. But the other part, too, that I'm going to say is that I don't think the world's going to come to an end in November. I do believe that we're going into about the second inning of a buyer's market. And what that means is that there's more properties coming on board. Some of the overpriced homes are starting to sit, and they're starting to come down in price. Now, albeit, we're not talking about, they're not going to come down 50%. Okay, that's not going to happen.
Not here.
But there are going to be some price reductions. And I think that that's where the value of working with Bradley comes into play because, again, as I mentioned when we first started out, he's in this fully immersed 24/7. He's going to be able to find properties for you that maybe you don't even know exist. They might not even be on the MLS. And these are called pocket or private listings where the sellers do not want people trampling through their houses on open houses on the weekends. They basically just go to Bradley and say, look, I want you to go into your network and Facebook and everybody else and find me somebody who's interested in buying my house without having to put signs up and doing open houses and people coming into my house. So I think that's super important. When it comes to interest rates, I do not believe that rates are going to skyrocket anytime soon. I think, we live in a bubble here in the Bay Area, and we think that everybody's doing this well. The truth of the matter is that the rest of the country is not. There's a lot of people still pulling out of the recession. There are a lot of segments of the population that are not doing well with employment, and as we all know, employment drives everything. If you don't have a job, you're not thinking about buying a house. You're not thinking about anything except surviving. And so with that said, remember that rates are global. They're not just based on San Francisco or the Bay Area. So I think hold tight, make sure that if you are committed to buying a house, there's never a better time than doing it now. But you always want to be looking for a deal. That shouldn't be based on the economy. That should always be based on letting your team know that this is your capacity and this is what you're looking for, and then we get to work.
Yeah, and I think to just kind of piggyback on that was awesome, Ed. I always tell buyers it really comes down to a couple of things. One is your time frame, right? If you're going to live and invest in the Bay Area or live and invest in San Francisco, and your time horizon is 7, 10 years, decades, ultimately it doesn't really matter when you buy. Get the best deal you can, work with the best team you can. But we're all kicking ourselves out there for not buying more in 2011, 2012, right? And back then we thought it was expensive. We're kicking ourselves for not buying in 2002, 2003, right? When homes were a third to half the price. So again, if your time horizon is years or decades, have that, different perspective on things and get in when you can. Talk to a lender, talk to Ed to get yourself financially ready to go, emotionally ready to go, and let's make it happen.
And I said just one last thing about that. And time horizons are super, super important, which is the reason why I always ask for how long do you think you're going to keep the property, not the mortgage, but the property. Because here's the deal: if you buy property here and you're going to keep it long term, then the strategy needs to be completely different than if you say, well, Ed, to be honest with you, I'm just going to live here for 3 years, which, by the way, is the average time that people stay in San Francisco. if you're going to live in it and you know for only 3 years because you're going to relocate somewhere else and you're going to sell that property to then go buy somewhere else, that strategy is completely different.
Yep.
Matter of fact, your mortgage program is probably going to be different as far as my recommendation.
Yep. Good. And I want to conclude this interview series. I've asked you a lot of questions, Ed. Again, I really appreciate all the insight and responses. I want to give you a chance to ask the audience any question you want. It could be real estate related or anything you want, but what's on your mind? What do you want to ask the audience? And the goal here is Ed's going to ask his. Sorry about that. So Ed's going to ask his question, and for those of you on the live stream, or if you watch it later on, please drop in your answers. Ed would love to hear your feedback and go from there.
My question just comes from, because I'm a heart quadrant person, what are some of the things that you're afraid of when it comes to pulling the trigger on buying a house, let's just say this year, maybe first quarter of next year? Do you have any fears? Because out of that question, I can answer a lot of those fears for you. And remember, I'm not taking the position that buying a home is for everyone, because nothing is for everyone, right? I don't believe in 100% or absolutes. But do you have any fears out there as to why you would not buy a property in the next, let's say, 6 to 12 months?
Very good question. That was deep. All right, good. Well, let's wrap up here. We're up against it in terms of time. I think Ed from Movement Mortgage was a great interviewee. Ed, if people want to get a hold of you, kind of share your contact information with them now. We'll also drop it in the comments too. But how can they get a hold of you?
You can email me. Email is always the best way, and that's ed.diaz, D-I-A-Z, at movement.com. So ed.diaz at movement.com.
Very good. And we'll put that in the comments later on for people to find. Ed's also very active on social media, so you can find him there out and about town. Very interesting to follow. Good. Well, I'm super excited. Thank you again, Ed. This is just the start for us. We're going to be doing more of these Facebook live streams. Again, the goal is threefold. One is to bring transparency to the real estate process. Number two, audience education. And three, just as an opportunity to reach people at scale. That was important to us because we are having a lot of these conversations. The FAQs are just numerous. So, how can we reach the most people possible? So, again, thank you, Ed. Thank you guys for watching. If you have any feedback on how we can make this better for you guys, because it is for you, drop it in the comments, shoot me an email, call me, and we'll be better from here on out.
Yeah, even topics that you want us to cover later on, that would be fantastic because we want to give you what you want.
All right. Thank you, guys.
Have a good one.